Hi everyone, my name is Sanon. I'm a student in business intelligence and data visualization. Today, I'm presenting an overview of the S&P 500 from the year 2000 to 2024. I'll show two different ways of looking at the data. First, through annual averages to see the long-term trend, and then through daily prices to highlight the short-term ups and downs we often don't see in summary reports. The data come from Stook, which provide historical S&P 500 closing prices. For this analysis, I group the data by year to calculate average closing prices. Then I use daily data to create a line chart that shows price movement over time. This way, we can compare how the market looks from a high level view versus a more detailed volatile one. Here's the bar chart showing the average annual closing price of the S&P 500. You can clearly see the market growth over time. There are a few key moments to notice. Look, here in 2008, where there's a big drop because of the financial crisis. But despite that, the index bounced back and reached over 5,400 in 2024. So overall, the trend has been upward. Even with even like the dot-com bust in the early 2000, the 2008 crisis, and the pandemic in 2020, the market has shown long-term resilience. Now, let's look at the daily closing prices over the years. This chart gives us a much more detailed view of how the market behaves, especially during time of crisis. Right here in 2000, we hit a peak of around 1,527 points during the dot-com boom. But that was followed by a big crash once the hype faded. Then, if we move to 2009, you can see this huge dip down to 676. This was during the global financial crisis when major banks were collapsing. Another sharp drop happened in 2020 with COVID-19. The S&P dropped to around 2,237 points. But what's interesting is how quickly the market recovered after that, unlike the longer recovery after 2008. So the chart really highlights the volatility that get hidden in the annual averages. These dips are major moments in the market, and they matter to short-term investors or people looking at market timing. So to wrap up, the bar chart helps us see the overall growth, which is good for long-term investors, but the line chart shows us the risk and volatility that happen day to day. When we combine both perspectives, we get a more complete understanding of the market, both its rewards and its risks. Thank you.